Iraqi dinar today latest news. Consider for a moment the profound implications of a physical asset, perhaps a collection of foreign banknotes set aside years ago, suddenly moving from a speculative curiosity to the focal point of an immense global financial reevaluation. For the longest time, the notion that holding certain foreign currencies could lead to a significant financial transformation was often relegated to the realm of hopeful fiction, a distant possibility for those with an optimistic view of global economics. The vast majority of people view currency notes left over from international travel as nothing more than paper keepsakes, fundamentally believing their exchange value is immutable. However, what we are currently observing is a convergence of very real and concrete signals emanating from respected central banks, major international financial organizations, and sophisticated institutional trading platforms. This collective movement strongly suggests that the prevailing narrative surrounding specific emerging market currencies is rapidly changing. And today our attention turns sharply to why the Vietnamese dong is attracting such intense and focused scrutiny from traders, high-level analysts, and global regulatory bodies. To accurately measure the potential scale of the shift concerning the Vietnamese dong, the critical initial step is to direct our focus away from the currency itself and towards the remarkable economic story of the nation issuing it. Vietnam has been the quiet architect of one of the most dynamic and robust economic transformations in all of Southeast Asia. Over the span of 2 decades, the country has meticulously transitioned from an economy heavily reliant on traditional sectors like agricultural products, specifically rice and fisheries, into a highly diversified and formidable industrial power capable of competing on the global stage. This comprehensive and strategic evolution was certainly not a matter of pure chance or a historical fluke, but rather the calculated outcome of deliberate, forward-thinking political reforms and an aggressively structured foreign investment strategy designed to draw in external capital. The success of this strategy is indisputable, as Vietnam has expertly positioned itself as a prime alternative manufacturing hub to China. This pivot has been highly effective in capitalizing on the growing global desire to mitigate supply chain risk and navigate complex geopolitical tensions, resulting in an influx of billions of dollars in foreign direct investment. When you observe major, internationally recognized technology conglomerates establishing sprawling manufacturing campuses and advanced research and development centers within Vietnam's borders, the narrative becomes crystal clear. The economic foundations of the country have been fundamentally strengthened and solidified, providing a tangible, real-world basis for a significant and overdue reassessment of its current monetary valuation on the international exchange markets. Despite this significant and observable surge in economic vitality and dramatic growth in industrial production, the Vietnamese dong has consistently remained at a deeply suppressed level against major global currencies for an extended period. Historically, this was a carefully executed and intentional strategy by Vietnamese monetary policymakers aimed at maintaining a strong competitive edge for its exports. By deliberately keeping the dong undervalued, Vietnam ensured that its manufactured goods, including textiles, electronics, and agricultural products, were attractively priced for international purchasers, thereby guaranteeing substantial and consistent trade surpluses year after year. However, the dynamics of the global economic landscape are now undergoing rapid change, and the persistent push for enhanced currency transparency and fair valuation policies is compelling the nation toward an inevitable monetary inflection point. Increasingly, there are compelling indications that the era of artificially suppressing the national currency may be concluding, driven by external forces. Pressure is mounting from key international lending institutions and foreign exchange monitoring organizations, all of whom are encouraging, or perhaps even requiring, emerging markets to modernize their antiquated monetary policy frameworks. This transition is much broader than just a local policy preference. It represents Vietnam's calculated move toward full compliance and deep integration with the exacting standards of the complex global financial ecosystem. The evidence suggesting this substantial monetary policy shift is not confined to standard public press releases, but is arguably becoming apparent within the intricate and often private internal workings of the global financial sector. Within the highly specialized world of private banking, particularly in the sectors that operate on institutional-level platforms far removed from consumer-facing services, a discernible increase in internal discussions and associated systemic adjustments concerning the dong has been documented. High-tier financial institutions routinely maintain proprietary rate sheets that are occasionally updated in anticipation of public market movements, based on observable liquidity changes and expected policy decisions. Recent reports from these deeply embedded circles suggest that several of these internal documents have displayed unusual and atypical patterns in relation to the Vietnamese dong. These are not the minor daily fluctuations seen on consumer travel exchange boards. Instead, they are the specific, early warning indicators typically monitored by savvy analysts preparing for evaluation adjustment. These observed anomalies strongly suggest that the core financial infrastructure of major international banks is being quietly prepared for a significant change in the dong's valuation, an event that has not yet been announced or reflected in the public facing exchange markets. Compounding this developing intrigue are the confidential leaks and speculative projections currently circulating among high-level financial professionals, which point toward post-adjustment values that are dramatically higher than the present exchange rates. While any specific numbers must be treated with the utmost caution and professional skepticism, the mere range of values being discussed within these professional circles clearly points to the expectation of a major monetary recalibration, suggesting a systemic shift is underway. Simultaneously, there have been numerous and well-documented observations of Vietnamese digital banking systems undergoing significant back-end software updates and technical modifications. These changes are reportedly designed to smoothly accommodate recalibrated financial balances and various denomination corrections. When the core banking software of a nation is updated to handle different decimal placements or altered rounding adjustments, it often functions as a crucial technical precursor to a major monetary policy shift. These quiet yet tangible technical mechanics represent the essential digital plumbing being put in place and tested before the official revaluation announcement. The pipes being laid down before the water is fully turned on. Crucially, Vietnam's current monetary transition is not occurring in a vacuum. The emerging monetary alignment appears to be inextricably linked with the strategic guidance and oversight of powerful global institutions. The International Monetary Fund, or IMF, has maintained an active and intensive engagement with Vietnam, focusing on key areas such as the strengthening of its currency reserves, the balancing of sovereign debt, and sophisticated inflation management policies. To the untrained observer, these activities may simply appear to be standard bureaucratic consultations, but for those who specialize in following global currency reforms, they represent the classic, required preconditions for a nation preparing to exit a historically suppressed currency regime. The IMF protocol typically involves a series of highly structured reviews and technical assistance programs designed to prepare economies for a shift toward more transparent and market-driven monetary policies. This work ensures that when a currency is finally permitted to float or is officially revalued, the national economy possesses the necessary shock absorbers to manage the transition effectively and maximize the benefits of the new valuation. In a parallel effort, the Asian Development Bank has also been a key partner, collaborating closely with Vietnam on ensuring capital flow stability and the comprehensive modernization of its essential monetary infrastructure, which includes the entire digital payment architecture. These coordinated and far-reaching reforms are precisely the types of policy upgrades required for a currency to transition into a more appropriate and fairer valuation range. When multiple, influential international organizations begin endorsing and supporting a convergent set of policy upgrades within the same tightly defined time frame, it is rarely a coincidence driven by random chance. Instead, it consistently suggests a coordinated, long-term trajectory toward a major new phase in the country's economic development. The combined weight of regulatory restructuring, digital system modernization, and shifts in reserve policy strongly indicate that Vietnam's long-term monetary strategy has decisively entered an advanced transitionary stage. Should these manifold indicators prove to be accurate, the financial influence of such a monetary move would extend far beyond Vietnam's borders. It would likely prompt neighboring emerging markets to urgently re-examine and reassess their own currency valuation strategies, potentially setting off a ripple or domino effect of regional economic maturation. For the private individual who may have acquired Vietnamese dong years ago, either as part of a deliberate diversification strategy or simply out of casual interest, these macro developments carry significant personal weight. If a revaluation were to occur on the scale currently being projected by insiders, the operational landscape for exchanging that currency will be profoundly different from a simple walk-in transaction at a retail bank. Current information from professional networks in North America, Europe, and Asia suggests that specialized, high-capacity redemption centers have begun to structure detailed internal procedures for handling potential HIVE-AL-U currency exchanges. These facilities are not the typical retail teller counters. They are sophisticated operations designed to process very large foreign currency transactions, complete with rigorous compliance screenings, stringent anti-money laundering checks, and advanced authentication protocols. It is becoming increasingly evident that in the event of a significant currency shift, the exchange process will be highly controlled, meticulously regulated, and distinctly separate from standard consumer banking activities, emphasizing legality and compliance above all else. The anticipated requirements at these specialized institutional-level centers underscore the serious nature of the potential event. It is expected that access to these controlled facilities will likely be by appointment only, and individuals will not be permitted to simply arrive unannounced with large holdings of currency. The expected prerequisites will almost certainly include comprehensive proof of purchase documentation, formal certificates of authenticity, and strict paperwork verifying the lawful and transparent acquisition of the currency. In a contemporary global environment of heightened financial security, individuals should fully anticipate undergoing background checks intended to prevent money laundering or the illicit use of any revalued funds. This emerging infrastructure is a clear sign that major financial institutions are strategically positioning themselves to manage a legal, compliant, and meticulously documented transfer of wealth, ensuring the entire process remains orderly and professional rather than chaotic or informal. This brings us directly to the vital importance of preparation. If the goal is to be correctly and legally positioned for a potential public revaluation event, one cannot afford to approach this passively or reactively. Preparation is not about simply waiting and hoping for an outcome. It is about guaranteeing that, should the opportunity materialize, the holder can navigate the complex administrative process smoothly and efficiently without encountering self-inflicted, avoidable obstacles. This necessary preparation involves several critical steps: physically securing one's holdings, systematically organizing all related documentation, thoroughly researching compliant exchange options, and proactively seeking qualified professional guidance. Many currency holders severely underestimate the critical nature of these administrative and legal steps until they are faced with time-sensitive decisions in an intense, high-pressure financial environment. By taking the time to prepare now, quietly and with methodical precision, one positions oneself to potentially benefit from a systemic financial shift that others may miss simply due to disorganization or a lack of documentation. The absolute and immediate first step in this essential preparation phase is the physical security and safeguarding of the assets themselves. If you currently hold Vietnamese dong stored in a casual location, such as an unmarked envelope, a shoebox, or an unsecured desk drawer, it is imperative to immediately upgrade your approach and begin treating the currency as a high-potential asset. Threats such as fire, theft, and water damage are unpredictable and real risks, and the loss of physical currency is functionally equivalent to the irrevocable loss of cash, as there are generally no insurance claims or replacement options for lost banknotes in these scenarios. A certified, fireproof home safe is a solid baseline option, while a bank safety deposit box offers superior, off-site protection. The key is to handle these paper notes with the exact same level of seriousness and diligence applied to valuable assets like gold bullion or essential legal deeds. Beyond the physical safeguarding of the currency, holders must meticulously document every detail of what they own. It is essential to take the time to record the denomination and the exact total count of all bills, and ideally, to record the serial numbers for all larger denomination notes. These detailed records should be maintained in both physical and digital formats. One written copy must be securely stored in a location physically separate from the currency itself, and another digital copy should be stored in an encrypted format, such as a password, protected cloud drive secured with two-factor authentication. This robust documentation not only offers peace of mind, but may serve as a crucial protective measure if future exchange regulations require verified proof of quantity during the redemption process. Equally critical is the careful preservation of the original paperwork associated with the currency's purchase. A common error is buying foreign currency and subsequently discarding the receipts, failing to realize that these documents form the necessary legal chain of custody required for verification during a structured exchange event. Whether the purchase was made from a licensed dealer, a financial institution, or a regulated online platform, all receipts, original invoices, certificates of authenticity, or transaction emails must be systematically collected and stored together in one organized file. Do not rely exclusively on physical copies, as thermal paper fades and documents can easily be lost. Digitize everything immediately and store the files in a password-protected folder. When the moment for potential redemption arrives, institutions may mandate proof of the date of acquisition to fully satisfy rigorous anti-money laundering AML statutes. This focus on documentation directly leads to the necessity of research regarding where one might eventually conduct a transaction. It is important to grasp that the primary objective is not to ask a local bank teller if they exchange VND today. The true goal is to accurately identify which major financial institutions possess the internal capability to handle large-scale foreign currency department operations and demonstrate deep knowledge of international banking compliance protocols. When conducting this subtle research, it is highly advisable to avoid using speculative terminology such as revaluation or RV, as these terms can trigger immediate red flags or dismissive responses from bank staff. Instead, position yourself as a client seeking detailed information about the bank's policies for exchanging substantial amounts of foreign currency in general, gathering intelligence on their verification procedures, not trying to convince them of a future event. As this crucial information is compiled, the necessity of professional guidance becomes indisputable. The fourth and perhaps most critical step is consulting with a fiduciary financial advisor. It is paramount to distinguish between a true fiduciary, who is legally obligated to act solely in your best financial interest, and a general wealth manager or insurance broker who may be motivated by sales commissions. Should a significant exchange occur, the resulting tax implications could be substantial and highly complex. Structured strategies, such as staged exchanges over time, the formation of trusts, or the use of specific asset reinvestment vehicles, could dramatically improve the long-term outcome. A qualified professional can ensure you remain fully compliant with all reporting requirements, preventing the loss of a significant portion of the value due to inadequate tax planning or unforeseen regulatory oversights. We must also candidly address the darker, more opportunistic side of these financial shifts, the inevitable proliferation of scams. The very moment legitimate opportunities begin to surface, illegitimate actors will multiply to prey mercilessly on the uninformed and the highly hopeful. Scammers thrive in environments where people feel both hopeful and uncertain, frequently claiming to possess special redemption windows or offering exclusive high-value rates if the individual acts immediately. You must understand clearly that absolutely no legitimate institution or government agency will approach you through unsolicited emails, social media messages, or private texts offering a backdoor exchange. All such communications should be ignored entirely. These scammers often impersonate government contractors or authorized agents, employing aggressive, high-pressure tactics to convince people to surrender their funds or highly sensitive personal data. Your financial safety depends entirely on your inherent skepticism and your unwavering commitment to only utilize verified, professional banking channels. In the online sphere, be especially wary of anonymous figures in forums who claim to have inside knowledge or backdoor access. These environments are fertile ground for sophisticated misinformation and targeted manipulation. As momentum continues to build around the Vietnamese dong, more people will undoubtedly be targeted by these schemes. Protect yourself by establishing strict personal rules. Verify absolutely everything, trust nothing unconfirmed, and never allow a manufactured sense of urgency to override your rational logic. Finally, let us zoom out to appreciate the greater global context. Because the events surrounding the Vietnamese dong are not an isolated domestic phenomenon. They are part of a much broader, systemic realignment taking place in global finance. A movement that includes the growing trend toward de-dollarization. For many decades, the US dollar has maintained its dominance in international trade and as the primary global reserve currency. But visible cracks in this monopoly are now appearing as emerging markets actively seek greater monetary autonomy. The rapid rise of economic blocs and the increasing number of developing nations establishing alternative payment networks are undeniable evidence of a collective desire for a multipolar financial world. Vietnam is strategically aligning itself with this new global framework, and its anticipated currency shift reflects a determined ambition to move toward fairer valuations and a more significant, influential participation in a diversified global monetary ecosystem. This global evolution is not a random market fluctuation. It is a structural adjustment where nations are increasingly seeking to match their true economic output and industrial strength against the valuation of their currency. The questions we frequently encounter often revolve around the matter of timing. While it is impossible for anyone outside of official channels to provide a specific date for a rate change, the internal banking updates we have discussed serve as the most reliable practical barometer of impending change. Historically, once major institutional platforms make the decision to adjust their back-end trading systems, the public facing currency markets eventually follow suit. This is not an instantaneous event, but a complex process of synchronization that ripples across vast international networks. Informed observers should maintain a close watch on digital banking updates in the region. as these technical movements are often the most accurate precursors to formal public announcements. Another common question concerns the exchange rate itself and whether all holders will receive an identical value. In virtually all major currency adjustments that involve institutional-level exchanges, tiered systems are standard protocol. Larger, well-documented and verified holdings often qualify for structured exchange agreements or incentivized rates, a policy designed by banks to ensure capital remains within the formal banking system. Smaller, retail-level exchanges may operate on a different tier with a distinct set of operational procedures. This is not a conspiracy. It is standard liquidity management used by major banks to prevent massive, sudden capital flight. Understanding this potential tiered structure helps holders to manage their expectations realistically and further reinforces the need for specialized professional advice on how best to navigate these likely layered systems. Ultimately, the difference between successfully navigating this event and missing the opportunity entirely lies in a single word: strategy. Simply owning the currency is not the same thing as possessing a meticulously planned and executable strategy for it. The individuals who consistently succeed during times of major financial transition are not the loudest voices on anonymous forums, nor are they the ones frantically chasing every fleeting rumor. They are the quiet, disciplined, and methodical individuals who prepare deliberately. They do not advertise their holdings or seek validation from strangers. Instead, they meticulously document their assets, consult with true fiduciaries, secure their physical currency, and think exclusively in terms of long-term wealth preservation rather than short-sighted, immediate spending. We may very well be standing on the threshold of one of the most significant monetary events of the current decade, a shift that the mainstream financial media has largely ignored until now. But for those paying close and careful attention, the shift in the financial atmosphere is palpable. The period of calm before the public recognition phase is the most valuable and productive time available to the currency holder. Your readiness, your comprehensive paperwork, your organization, and your detached mindset will be the defining factors that determine whether you are merely a spectator watching history unfold on a screen or an active participant moving confidently through a system in transition. This is not about making speculative predictions. It is purely about positioning yourself strategically so that you are fully prepared for whatever reality eventually transpires. The Vietnamese dong is actively transitioning from being a relatively forgotten foreign note into a key player in a new, emerging financial era. The global financial world is demonstrably changing, moving away from outdated centralized frameworks toward a multipolar landscape where emerging market currencies will share influence. Stay prepared, stay focused, and stay thoroughly informed. This is the Iraqi Dinar Today latest news, signing off. Would you like me to focus on another part of the original transcript for more detailed analysis? Or would you like to review other recent developments in the Iraqi dinar market?